Always tough to go after a marketing person. I think one thing he said which kind of stood out for me was marketing is about what can happen, finance is about what has already happened. I'm going to spend a little bit of time talking about what can seemingly not be possible or not happen. So when you think about capital, right, the first thing that comes to mind is equity. And that's the most common form of capital that companies, especially early companies, are known to raise. My life and my business today is about something called venture debt. So let me throw out a few things. I'm going to be one of those painful guys who keeps asking questions from everybody around. I used to hate it in college, but found that it typically keeps people awake. When you individually all run companies or you have businesses, when you have to go and take a loan, what are the things that typically you get faced with? I'm assuming all are young companies. What are the questions that you get when somebody evaluates you for a loan? I really need some answers.
Net worth.
Net worth is one, okay.
Security.
Security in terms of assets, okay. Cash flows, profitability, right? And the business that you run, the industry that it is in, growth, cash flows and forecast come together. So all of these are conventional, right? These are all conventional ways in which lenders are taught and trained. Now think about situations where a company is non-profitable, has minimal assets on the ground. Say you take a logo making agency, right? Or a service company where your assets are your people, right? The person who starts the company is a professional, so no net worth. It's a person who 30 years and he suddenly decides, okay, he or she decides I want to start a company and moves on and starts a company. So no net worth, so no guarantees, may not even have a house to mortgage, right? How do you provide debt to a company like this, where all the boxes are crossed, right? And this does not fit the conventional mold of financing, right? That's what I do. So in a nutshell, what I do is provide venture debt, which is structured debt to companies which are very early, at or after raising a Series A round of financing, and all the way up to raising $150 million of equity and getting to a really mature stage. So we treat this as an art and a science. It's very easy to lose money doing this business because at the end of the day, they may not be assets, they may not be net worth, they may not be proper cash flows. But guess what? We've done about 70 transactions across about 50 companies. And so far, it's been a good experience. It's been about 6 years in India. And the parent organization is actually about 3 decades old in the US. So that's in a nutshell what venture debt is, right? So some of the questions that I was thinking about when we talk about capital, and just to give you guys an idea, and we'll have a better understanding of more growth stage and late stage capital through the session. I want to focus a little bit about early stage and younger companies when they go out raising capital. What can they keep in mind and what are the options in front of them, right? So the venture capital ecosystem in India is pretty young. That is the first thing that all of us should be aware of. It is unlike, say, US or in the Valley where it's several decades old. We are just about seeing the first cycle of venture capital investments, which means that we have investors who are still finding how things work, right? I mean, these are investors who sometimes have experience from another market, which really doesn't apply here, because the traditional venture capital mold or growth equity mold outside is you back intellectual property, you back technology companies, you back high growth companies. In India, there's a huge market which is available from domestic consumption. You don't need to have IP driven companies for companies to become successful. I mean, what did a Flipkart do or what did a Just Dial do? I mean, these are not companies which have proprietary IP and hence became large successes, but they just made things more efficient. They ensured that a product and a customer are matched, right? So from an investor's perspective, India actually is a very different market compared to the other markets. That's why we see more investments going into areas like consumer, healthcare, delivery, education. These are all sectors which are not touched in most of the mature markets. Our business has seen the same kind of evolution as well. So we funded companies from, say, a Satyapal, which is premium apparel, to a Mintra, which is in e-commerce, technology companies, Fasos, which is a wraps and rolls company. All of these, now what do they have in common, right? These are across the board in terms of sectors, but they either had a good brand or a strong team or a process which was really efficient and that gave them a barrier. So in India, IP is all of these things. It's not about the patents that one has in the valley. It's about differentiators which are more, which may not be so intuitive or so obvious, but actually give companies an advantage. That's what we look out for, that's what investors look for, and hence it's a very different market compared to the rest of the world. China may be similar in many ways, but Israel, Europe, US, totally different in terms of the approach. Having said that, we're seeing actually a kind of rebound of technology firms in India. So in the last couple of years, a lot of people moved back from the Microsofts and Googles and Facebook to Bangalore especially, and we're seeing a growth of companies there in analytics, mobility, technology-related areas, or not just technology-enabled areas, which is interesting, which is heartening. There is a much wider market which is non-technology, right? And that is still getting funded. There's still investor interest to fund those segments as well. But the last couple of years have clearly shown that technology is back in an Indian way. It's not the American way. What does an investor look for in an early company, right? A young company, what does an investor look for? The first thing, there are 2 or 3 things that an investor would look for. It would be, how big is the market, right? I mean, when you start, there's going to be a long journey, and you're going to learn, you're going to make mistakes, you're going to learn, you're going to do better. But at the end of the day, if you're going to be the market leader in a small market, it really doesn't help anybody. So when a company hits out against a pretty large market potentially, with a product that actually has a fit with the market, that's a significant step forward when you're talking about an early stage investment. The second thing would be the team, right? I mean, who's there at the top? What is the founding team? Is it one person? Is it 2 people? It's always only at the top. 2 founders better than 1. Many founders may be a problem, but single founder companies we've seen, often the stress is a bit tough to manage. It's also good to distribute functions. It's also good to distribute responsibilities, but still have accountability at the top. So how good is the team at the top? If these questions are broadly answered, I'm talking about a Series A kind of financing where typically investors look to write checks of a few $1 million. That's what they look for. It's not necessary that a company has to have profitability or great cash flows at that point of time, but it needs to have the potential, the raw ingredients, the people, and a fit between what they're trying to do and what the market actually wants. A part of that was in the last discussion as well, which is ultimately you could be doing something sexy, but if there is no market for that which is viable, it really doesn't help anybody. What does an investor bring to the table, right? That's another question that is asked often in terms of, there are 15, 20 different investors are pretty active. How do you pick and choose if you have the luxury of picking and choosing? In my experience, and most of my life is talking to various venture capital and private equity investors, and we're like Switzerland because we're neutral, right? We don't compete with them. Most investors, in my view, and many are pretty candid at that, give you money to grow the business. They are not going to jump in and run the company. They are ensuring that you have equity capital to run your business. There is a belief in what the entrepreneur brings to the table. There is a belief in the market. And that's what I've seen most investors do. The exception is where an investor would roll up his arms and kind of get into the business. That is, in my view, the exception and not the norm. In many ways, I think it's preferable that things remain that way, because when an entrepreneur runs a company, you know exactly what's happening, right? I mean, you are actually solving problems. You're in the thick of it. It's often, one board meeting every 3 months is not going to give people enough insight to exactly say what needs to be done. So an investor's role is more to be a catalyst, have introductions done, open doors. I think that's one great value add that many investors have done, which is in your space, there should be a capability to actually open doors and make connections, be it for sales, be it for allied, for people, if you need a right brand to attract human resources. These are all areas in which a good investor should be able to help. And especially when an investor is on 8 or 9 or 10 boards, it is unlikely that any one company, unless they're going through stress, that actually see day-to-day engagement. Scale is another thing that companies need to keep in mind, and this is where kind of capital itself comes into question. Leverage in terms of debt, equity capital, the kind of investors that are there for a company. So there are many questions that one needs to think about. Do you go with 2 investors versus 1? Do you know what the investor's position is? For example, every fund has a life cycle. Is an investor in his 2nd year or 4th year or 6th year of investment? That has a big role to play in terms of how much more money they can put into a company. It has a role to play, so there's capacity intent, right? So if a company raises any kind of formal equity, you can go through a period of stress. The best of intent can be there, but if there's no capacity to follow through with further funding, it really doesn't help you. Having said that, there are no commitments or guarantees on day one, right? Every investor would want the company to perform and go on a particular path. But as an entrepreneur, this is assuming there's choice, you need to be cognizant of what is the probable path that the company could take, and if the situation warrants it, how can the investor support you? Can there be further funding even if milestones are not met? Is there a cap in terms of timing where the investor can go? Is there a cap in terms of size that the investor can go? These are all questions that you need to ask upfront, because it's a marriage, right? I mean, it's a marriage, it's a pretty long marriage, often a messy marriage, which means that there's a responsibility on both sides to ensure there's alignment. It's not just about who writes the best check. It's not just about who gives the best valuation. It's about who's the right fit for the company. So when you're raising money at a Series A versus, say, the 3rd round or 4th round where the company is much more mature, there's different bands of investors who are, and there's a few who straddle all the way through. It's important for you to recognize what you want at that point of time and whether the investor brings your requirements to the table. In India, the reality has been that there are a handful of companies which see a flurry of activities, a lot of investor interest, then there's a big vacuum. And that's been the phenomenon in the last few years, because the good companies get 10 people chasing them, and then there's a lull, right? There's nobody chasing companies beyond that. That's also the way it works. I mean, there's a lot of flavor of the season, as we call it. If one deal gets done, we see 4 deals getting done in the same space in the next 6 months. That's the reality, right? And that's the reality in this market. That's the reality in many other mature markets as well. It's important to be there in front of investors at the right time. It's important to use all possible avenues, be there in social media, be present, be in front of people that matter. Ensure that you're creating your own brand individually as well as the company's brand. Ensure that the chemistry is good between the potential investor and yourself, because it goes beyond just writing a check and coming to a board meeting. You need to be comfortable both sides with this relationship. So there's some broad thoughts on the equity side. On debt, I don't want to spend too much time at this point because it's a fairly new product that we have. I'm happy to take specific questions on that. Our aim there is to help companies extend cash flow runway between equity rounds. So what we try to do is, if you raise equity, we will give you some more capital to help extend your cash flow runway, make yourself more valuable, and then raise an extra round of equity. And that's found a lot of takers in this market, clearly because it improves, reduces dilution for promoters and also improves returns for the investors. So that's what I do as a business, but wanted to focus a little bit on equity as a more generic discussion topic.